Good afternoon, everyone. Thank you for attending this webinar. This is a defining moment in the history of the Euro and the European Monetary Union that was created in the late 90s in order to launch the European Union into a new phase of its economic integration process, which involved a common currency, a common central bank, a common monetary and exchange rate policy, on top of the existing trade union that had been created. Now, today's session has the following objectives. Basically, what I'm trying to answer is what has brought the Eurozone into crisis, what has caused this debt crisis in the Eurozone, what actions have been taken by Eurozone governments and the European Commission to stem the crisis. Will the actions taken already prove sufficient to solve the problem? What else or more needs to be done to resolve the problem, which we see is not solved? And what's at stake for the world economy, for Europe, first and foremost, for the world economy, but also for us here in Canada? Ultimately, the issue in today's webcast is, will the euro survive, and what form a post-euro world will take? Now, if there's one theme in my analysis, it is that there is a solution to the European debt crisis, a solution that has been overlooked so far because the Eurozone governments are 17 different sovereign governments, sovereign parliaments that need to decide. It also requires a vision for the future for the Eurozone, and it involves completing the steps that have already been taken, which means that any credible, sustainable monetary union requires also a fiscal union, with a common debt policy, a common debt instrument such as a Eurobond, a bond issued collectively, jointly and severably, backed by all Eurozone governments together. That is the real answer to the problem that the Eurozone solves. So if there's a theme that will be carried through my presentation, that's the theme. Now, let's turn to the first slide. What caused the debt crisis in the Eurozone? Can everybody see the first slide? Okay, great. So, let me see if I cannot change the slide from where I am, Nina, so if I'll prompt you to change the slides when we get through them. So, what caused the debt crisis? Well, first of all, the Eurozone debt crisis is not a separate event. It has to be seen and understood as part and parcel of the global financial crisis that started in 2008 and engulfed the whole world economy, along with the impact it had resulting in the global downturn or recession, or Great Recession as some call it, of 2009-2010. So this is a continuation of a crisis that has already started before. What has happened, what the Euro debt crisis is all about, is that the crisis from North America and UK has metastasized into a sovereign debt crisis of the Eurozone member countries. Turning to the next slide, when the debt crisis occurred in 2008, governments bailed out the banking system in order to prevent a financial collapse of the global financial system. But to save the financial system from collapse, governments transferred losses from the banking and financial industry to the public sector. Basically, the governments socialized the losses of the banking sector, even though it allowed them to keep or privatize the gains. So there was a transfer of liabilities from the banking sector to the public sector. At the same time, these governments already had high levels of debt. So adding significant amounts of additional debt to their balance sheet, to their liabilities, it made an already precarious public debt problem more serious. At the same time, the global recession cut deeply into tax revenues, increased budget deficits, and prompted governments to spend more on social spending to try to balance the equation. Let's turn to the next slide. Now, while these actions succeeded in averting a collapse and preventing what many say would have been a Great Depression, and they helped the banking sector regain its solvency and has restored a lot of stability in the banking sector. We've seen bank prices, stock prices rise, the market capitalization of the banking system increase, financial markets have returned to a calmer mode. However, at the same time, the debt levels, the debt as a percent of GDP in these governments has risen, and the credit rating agencies have started cutting the credit ratings of many of these countries, including, as you know, the USA, which was cut last July from AAA to AA+. Now, this is basically the crux of the situation. The private debt has been, the losses of the banking sector has been transferred to the public sector, so the global financial crisis has metastasized into a sovereign debt crisis. Now, on to the next slide. Now, the United States and the UK, originally the epicenters of the global financial crisis, have seen their budget deficits soar to above 10% of GDP, while debt to GDP ratios have reached above, gross debt, for example, above 100% in the US and almost there for the UK. Why is the US and UK not the epicenter of the euro crisis? Why is this crisis manifesting in the eurozone? That's a basic question that needs to be answered. And the answer is that the eurozone is a special construction. It is a new construction. It's just over 10 years old. It's incomplete and places very high demands on its members, while it leaves them with fewer tools to manage their economies. Next slide. The EMU is a union of 17 countries, is a currency union of 17 countries. They have a common central bank, the ECB, European Central Bank. They share the same common monetary policy throughout the Eurozone, and by extension, the same exchange rate policy. Each member country can no longer change its interest rates or adjust exchange rates to deal with any domestic imbalances. The only tool at their disposal is fiscal policy. But even then, there is a limit to how much they can use fiscal policies, because based on the Maastricht Agreement and the Growth and Stability Pact that the European governments have agreed to, they're not allowed to maintain budget deficits above 3% of GDP, and they're not allowed to keep their debt levels above 60% of GDP. Now, on to the next slide. The Eurozone is a monetary union, but not a full-fledged economic union. Although these countries share the same currency, each country is responsible for its own debts. its own fiscal policy, and its own banking system. There's a fatal flaw in the design of the European Monetary Union that has been pointed out by economists from the very beginning. You cannot have a stable monetary union without a fiscal union at the same time, with a common treasury and debt issuing agency. Now, turning to the next slide. A fiscal union means that all member countries pool their debts into a single common eurozone debt, issue a single euro-wide debt obligation such as a Eurobond, and coordinate and harmonize their fiscal policies. That's what a fiscal union implies, that they share the debt together and issue eurozone bonds for all member countries. Within any economic union, as within any single country, some regions produce more than they consume, while others consume more than they produce. Money generated in the surplus regions flows into the consuming regions to help finance their purchases and maintain a balance in the whole system. So financial imbalances within the union should no longer matter anymore as imbalances with countries outside a single union matter. Now, moving on to the next slide. The fiscal union, okay, I'm sorry, let me turn to the next slide. Now, in the absence of a fiscal union and a common treasury, what happens? Each country is responsible for its own debts and needs to finance them on its own in the global financial market. If its debt level, payment imbalances, or budget deficits rise too high, then the markets lose confidence or refuse to finance them, which results in a liquidity or possibly an insolvency problem for the member state, which then puts pressure on the rest of the members and the rest of the system, and results into the problem we're facing today, the crisis in the Eurozone. Then either the member has to take drastic action to resolve the problem on its own, or other members are compelled to intervene to assist the weak member to overcome their problem. On to the next slide. When the euro was launched in 1999, interest rates in all peripheral member countries from Ireland to Portugal, Spain, Italy, and Greece fell dramatically. And they fell to reach the low levels of interest rates in Germany and France. At the same time, euro area banks could buy bonds, in other words, lend to these countries, on the understanding that they were risk-free, like bonds issued by their home country. The European Commission and the European Central Bank interpreted the Basel II capital adequacy rules to mean that euro area banks did not have to post any additional or separate capital against their purchases of Eurobonds of euro area countries. In effect, bonds issued by peripheral countries like Greece were considered entirely risk-free, of the same quality, in effect, as German bonds, and could command the same interest rates as German bonds. On to the next slide. This action opened the floodgates of lending to these countries at the same time as the United States was engaging in the biggest bout of monetary expansion in modern history. Just a bit of a background here. In 2001, following the meltdown of the dot-com and the information technology sector in the United States, the United States was plunged into a recession in 2001. The Federal Reserve slashed interest rates. Alan Greenspan was then the governor of the Fed, slashed interest rates to 1% in 2003 and kept them there for over a year. The result was that too much money flowed suddenly into countries that were ill-prepared to deal with much money all at once, either because they were financially unsophisticated borrowers, institutionally weak, or were uncompetitive to make the most efficient use of these funds. This resulted in housing booms in some countries like Ireland and Spain, or budget deficits in other countries like Portugal and Greece. Turning to the next slide, as the global financial bubble burst in 2008, bringing down the financial system and the global economy with it, this pushed weak euro area countries with high budget deficits and external debt exposure and high public debt levels over the edge. It's basically what happened to Greece. But other things happened just before that. First, back in 2008, over the edge were Iceland and the Baltic economies of Lithuania, Latvia, and Estonia. Since they were not in the euro, in the eurozone, you did not hear much about them in the press. Then came Greece in early 2010, followed by Ireland and Portugal later in the same year. Since they were euro members, however, that's when the story hit the news as the euro debt crisis. Now, it is Spain and Italy that are threatened, along with Hungary, a non-euro member. Europe's response to the crisis. Now, what has been Europe's response to this crisis? So let's turn to the next question. Well, Europe's response has been muted because the extent of financial stimulus that was given to Eurozone countries was much less than that provided in the United States or the United Kingdom, while the extent of fiscal accommodation has been far less as well, actually less than half that provided in the US and UK. For example, from a study, if you can turn to the next slide, Nina, from a study by Alessandri and Haldane, Banking on the State, which was published by the Bank of England in late 2009, one can see in this slide that the United States and the United Kingdom provided emergency financial assistance to the banking sector in the form of printing money, government guarantees, and insurance, and capital injections into banking firms to the tune of $10.5 trillion for the U.S. and $1.8 trillion in the UK, amounting to 3/4 of the GDP of these two countries. What the response in the Eurozone has been, as you can see, is far less. The Eurozone injected only $3 trillion, accounting to only 18% of the Eurozone's GDP. So not enough liquidity was injected into these economies in order to extinguish the fires that were started by the global financial crisis. Turning to the next slide, we can see what the fiscal response of the various countries were. As you can see, the red line on top, that's the United States, followed by the UK. At the bottom, the blue line is the Eurozone. The budget deficits in the United States and the United Kingdom rose to well above 10% of GDP, whereas in Europe, they only reached 6% of GDP and then started declining afterwards. So you can see that the fiscal response in the Eurozone was about half that of the other countries. Now, turning to the next slide. Fiscal injections. Fiscal injections in terms of budget deficits were more than, were less than half in the Eurozone. And most peripheral countries, and not only this, but the United States and the UK took allowed more time for these budget imbalances, budget deficits, to be resolved. Whereas the Eurozone started putting a lot more pressure on the countries to cut their deficits in order to go back to the Maastricht rules of balanced budgets and low debt to GDP ratios. Next slide. Now, the European Central Bank, the only functional institution in the Eurozone and the most powerful one, responded initially by buying peripheral country bonds in the secondary market in order to prop up their prices and put a floor on bond prices, this way preventing yields or interest rates on these bonds from rising too high to unsustainable levels. And at the same time, by preventing bond prices from falling too low, help protect the Eurozone banking system from huge losses in their holdings of these bonds. The audience must remember that the Euro area banks, because they assumed that bonds of peripheral countries were zero risk, never set aside capital against possible potential losses in these bonds, nor have prudential reserves been sufficiently boosted to cover future potential losses. In December of 2011, the European Central Bank launched the long-term refinancing operation, whereby it started lending euro area banks 1 trillion euro to hold bonds of euro area governments for a period of up to 3 years. And this action was quite successful in helping slow down the crisis, and this is why we have experienced calm the last few months. Now, turning to the next slide, although the ECB has been at the forefront of battling this crisis, one must remember that it has also operated with substantial constraints. First, the ECB's only mandate is price stability. It has no mandate to pursue economic growth, which is the case with most central banks in the world. The Bank of England, the Federal Reserve, or other central banks have a dual mandate, not only to keep inflation low, but maintain growth in their economies. That is not the case with the European Central Bank. Secondly, it is not allowed to create money and serve as a lender of last resort, as most central banks do. The purchasing of bonds by the ECB of area country members is strictly prohibited by the Growth and Stability Pact in the Eurozone. Even the actions it has already taken have violated its mandate, resulting in the resignation of 2 senior German board members. It is basically, in doing what it already did, the European Central Bank has skirted the rules in defending the euro. There's a fine line between illiquidity and insolvency. The European Central Bank is there to finance crises, to step into crisis when there's an illiquidity problem. If it becomes an insolvency problem, which means the borrower is unable to pay, the European Central Bank is not allowed to purchase its bonds, because that means that the European Central Bank is bailing out a euro member country, which is strictly forbidden by the Growth and Stability Pact. So when we turn to the next slide, when Greece, Ireland, and Portugal lost the confidence of the bond markets in 2010 and were unable to finance their debts at sustainable rates, Germany and France, the principal core members, came to the assistance of these countries with the help of the IMF. The European Commission, the ECB, and the IMF, the so-called Troika, offered emergency bailout packages to these countries on the condition that they undertake austerity measures to eliminate their budget deficits, along with structural reform measures to open up their labor markets and make their economies more competitive. To funnel funds to these countries, they created the European Financial Stability Facility, the EFSF, which has then been transformed into the European Stability Mechanism, or EFSF, which is about to start on July 1st, 2012. Initially with €500 billion that has since been raised to €750 billion. It has a capacity to lend money to countries that are experiencing problems. Now, each country contributes to this fund strictly on the share for which it contributes to the European Central Bank, which means that the debt of the EFSF is not joint and severable by all EU zone countries. Now, the EFSF borrows at AAA rates in the market and then lends to the debt-stricken countries at a reasonable but higher rate. Now, the EFSF and its successor, the EMS, have proven adequate to service the needs of Ireland, Portugal, and Greece. If the crisis spreads to Spain or Italy, the firewall attempted by this fund will not be adequate to take care of the needs of Spain, let alone those of Italy or Spain and Italy combined. Should that happen, they will need more than $3 trillion in the fund. At the same time, the taxpayers of the countries on the lending side of these funds are becoming increasingly disdainful on the prospect that they're assuming the risks and debts of other, less prudent and more profligate countries. Now, the first test case of the euro response to the crisis was Greece. But the strategy has failed. Greece never experienced a recovery from the global downturn of 2009. Its economy is now in the fifth year of economic contraction. GDP is in line to fall by 20% by the end of 2012, to fall 20% from the previous 2008 levels, while unemployment is approaching 25%. Greece's problem was maldiagnosed as a liquidity problem and has since evolved into an insolvency problem. When the Troika finally admitted that the full scale of the problem, they decided to write off part of Greece's debt by doing a restructuring called the Private Sector Initiative, PSI, which succeeded, as of March of this year, in erasing about 74% of the present value of Greek private sector government debt held by the private sector. If you look at the next slide, it gives you a picture of how deep the downturn has been for Greece. It's basically of depressionary proportions, and how high the unemployment rate has risen. Now, moving to the next slide, although the debt restructuring or soft default erased much of Greece's debt, about a third of Greece's debt, even after all this adjustment and bailout plan is implemented, it is still expected by the IMF to be at 120% of GDP. The debt to GDP ratio will still be 120% of GDP by 2020, which is still an unsustainable level. Faced with the prospect of years of austerity and hardship, the limits of social and political tolerance were reached in Greece during the May 6th national election, which polarized the Greek political scene and gave anti-austerity and anti-bailout parties near 50% of the vote, enough to obstruct the bailout package and cancel the structural reforms. So the Eurozone is now plunged again in a renewed and potentially deeper crisis. Now, have these actions proved sufficient to resolve the crisis? The tragedy of the situation is that despite the best efforts of the Troika the crisis has mutated and spread to more countries in the Eurozone. On May 15th, Eurostat announced that half of the Eurozone is in recession. If you can turn to the next slide, Nina. So half the Eurozone is in recession. The probability of a disorderly exit from the Eurozone by Greece has risen to more than 50%, with, I'm afraid to say, catastrophic consequences for Greece. While the collateral damage this event could have on the Eurozone and the world economy is incalculable at this time. Should Greece exit the Eurozone, consider Greece dead and the rest of the Eurozone severely wounded. Let's move to the next slide. And the one, yes. Now, at this moment, Greece is heading for another election on June 17th, 2012. Unless the Greeks come to their senses and start thinking rationally instead of emotionally, unless 35% of the Greek electorate that abstained from the May election decides to come back in and vote for a pro-austerity Eurozone party, it is a foregone conclusion that Greece will be forced to leave the Eurozone. Not because it will be pushed out by other members, but because circumstances will cause a run on the banks, something that we've already seen. This past Monday, $900 billion were moved out of banks, and the hemorrhage is continuing. And this can cause a complete meltdown of the Greek banking system, which will basically make it necessary for the Greek government to either go to the drachma or print some kind of temporary notes to allow people to allow the economy to function. Now, turning to the next slide, should this occur, the markets will start asking which other Eurozone country will be next in line. The uncertainty and chaos that will be unleashed may prove enough to force other Eurozone countries out of the euro. When one looks at the economic fault lines in Europe, other countries that potentially could eventually leave include all of Southern Europe, like Portugal, Spain, and Italy, and even possibly Ireland as well. At this late point in the crisis, expanding the European stability mechanism, the so-called firewall, will not prove enough to prevent the inevitable. Next slide. Now, what more needs to be done? Well, the second strategy is that there has been a solution on the table all along that Germany has refused outright to consider. If the European Union wants to be called a union, wants to have a common currency and a common central bank, it also needs to pool its separate national debts into a common and collective debt. Have a common debt instrument such as Eurobonds, have a common treasury and debt issuing agency, and it also needs to coordinate fiscal policy. If all Eurozone member countries were to resolve to pool their individual debts and issue common bonds that will be jointly and severally backed by all member states, in exchange, of course, for establishing a Eurozone treasury with common fiscal rules and structural reforms accompanied with this measure over the medium term to ensure that the periphery becomes more competitive, the crisis would end in one single day. Consider the idea of a Eurobond. Instead of having 17 separate and fragmented national markets for bonds, why not have one integrated pan-Eurozone bond market? Already, all Eurozone bonds are issued in the same currency. Multinational companies issue euro-denominated bonds that are sold in one single wide Eurozone corporate bond market. Why not do the same for Eurozone government bonds. By issuing Eurobonds and creating a common market for European government bonds, a 13 trillion European government bond market can be created to match the 15 trillion U.S. government bond market or U.S. Treasury market. Confidence would be restored overnight in the euro-denominated bonds, and borrowing costs would plummet to the benefit of all Eurozone states. Such a market would command a credit rating at least as high as that of the United States, that is AA+. For the security, liquidity, depth, breadth, and efficiency of this market, bondholders would be prepared to pay a higher price, and Eurozone bond yields would plummet for all member states, not just for few like Germany, but for all of them, including Spain, Italy, not to mention Greece. This could save the Eurozone member countries over 150 billion euro a year in interest payments, and this saving could be used to reduce the budget deficits, restore sustainable fiscal balance, reduce the need and intensity of austerity measures in the short term, while give Eurozone countries more time in the medium term to structurally adjust their economies and improve their competitiveness. If you look at the next slide, it shows basically what I call cannibalism. You see, while Spanish bond yields are rising, above 6% in this chart, the yields on German bonds are falling to record low levels of below 1.5%. You see, there's a flight to quality going on. But this flight to quality benefits one Eurozone country while it hurts the other, and basically rips apart the Eurozone. That's the danger. If all Eurozone countries combine their debts, that wouldn't be happening. The entire debt of the Eurozone would be solid, yields would be falling, while crises outside the Eurozone would prompt money from other parts of the world to be invested in Euro bonds that would lower the yields for all of these countries. Now, turning to the next slide, many political leaders think that they will lose some of their economic sovereignty if they combine their debts and form a common treasury. What they don't realize is that in a global economic setting, where they're part of a common currency, an integrated union, and where the collateral damage from the breakdown of the EMU is so large, they no longer have sovereignty over economic affairs. Rather than suffer the painful consequences of a breakup, they might as well embrace the common benefits of a fiscal union. If they're not prepared to stand together, they're poised to fall together. Now, what's at stake for Europe? At stake is the financial prosperity of the whole European continent, and Germany as well. Germany and a few other member countries may be doing well right now, but they will not continue doing well if a breakup occurs. If the EMU experiment ends in failure, it will unleash enormous amounts of resentment, mistrust, and animosity within the European family that will set back the project of European integration for a long time, maybe a whole generation. In addition, the economic weakness and bickering that will ensue will have major unintended consequences. China, Russia, and other newly emerging powers will start vying for influence inside the European continent. Geopolitical events emanating from the Middle East or other parts of the world might destabilize the balance of power, especially in Southeast Europe, that might force Europe into much costlier adventures, including war. If you move to the next slide, Nina, with the chart. The EU is the world's, the one after that, the EU is the world's largest economy. The Eurozone is second only to the US. The world economy is resting on three pillars: the United States, the European Union, and East Asia, meaning China and Japan combined. A breakup in the Eurozone will severely compromise one of these three pillars. It will undermine Euro-Atlantic alliance. The financial position of the United States economy, let's not forget, is already highly precarious and vulnerable to disruption. The collateral damage that will follow a breakup in the Eurozone might prove the proverbial straw that broke the camel's back. Let's be realistic. The financial stability, security, and prosperity of the entire world depends on what happens to Europe. Now, turning to Canada. Economically and geopolitically, Canada is fairly removed from Europe. That's true. Although the collateral damage may not be as severe for Canada, the consequences, both direct and especially indirect, may prove quite painful in any case. Canada has a very open economy and depends heavily on commodities and international stability and growth. We also depend disproportionately on the United States, which means that the more badly the U.S. is affected, the more it will affect us here in Canada. Finally, unless European leaders find the courage, the vision, and the resolve to pool their debts together, issue Eurobonds, create a common treasury and a fiscal union, the Eurozone, as we know it, may not survive. At best, it will survive in the form of a retrenched union of fewer members, like Germany, the Netherlands, Belgium, and France, diminished in stature and power. At worst, it could break up completely and take a whole generation to digest the lessons of the experiment and rebuild in the next generation on a sounder basis. Alternatively, if Greece exits the Eurozone, the European exits and experiences a catastrophe, which is most likely. It's going to be far more catastrophic for Greece than for the rest of the Eurozone. This might prompt Eurozone partners to lend greater support to the other countries like Portugal and Spain and Italy, and give them more time to adjust to the austerity measures. So let's hope that common sense and leadership will prevail to prevent a major financial calamity of global proportions. Thank you.
Thank you very much, Dan. A fascinating session. I'd like to invite anyone to ask a question by typing it into the question box. Once again, if you look to the top right-hand corner of your screen, you will see some vertical icons. Click on the red arrow and you'll be able to access the question box there. While we are waiting for questions to come in, there's a saying in the business world that you need to spend money to make money, and that organizations that simply look at fixing the bottom line by cutting costs eventually get to a point where the products and services that they're delivering end up suffering. It seems as if some countries now believe that the way to get out of this mess is through austerity, but austerity appears to be contracting economic growth in countries such as Greece. Seeing that other countries invested in infrastructure to stimulate economic growth during the economic crisis of 2008, 2009, what keeps the Eurozone from implementing similar programs?
What keeps the Eurozone is that from the beginning, they didn't want to create a common treasury. They only wanted a common currency without a common treasury. Countries were reluctant to assume debts or combine their debts. So to make the currency union work, they set this requirement that each government keep its budget deficit to less than 3% and debt to GDP ratio to less than 60%. So this is the constraint that the Eurozone countries have imposed on each other. And this is what preventing them from looking at any growth strategy. So what they're trying to do is force all the adjustment to the periphery in order to resolve the problem. And that is the risk, that any solution requires that both sides do their part. The core has to spend more and has to look at outside the box, more creative solutions to back the debt of the periphery countries in order to take pressure off the bond markets and allow yields to fall and allow their budget deficits to shrink, and have to give these countries more time to implement their structural reforms. Structural reforms take time. They don't happen overnight. So the solution being pursued right now by the Eurozone will not work. And the newly elected president of France, François Hollande, is correct in that we also need some kind of growth strategy to accompany the austerity and reform package.
Fascinating. We have some questions that have started coming in now. Olivier is asking if the Eurozone were to start issuing Eurobonds, what kind of rate would a country like Germany end up paying?
Well, an analysis that I've done and published recently in the Journal of Wealth Management shows that Eurozone bonds would trade at the same level as U.S. Treasuries. Yields could fall to levels below those that Germany had before the crisis began. The reason being that if there are when there is a crisis in the world, there's always a flight to quality, and investors run to the safety of U.S. Treasuries. What makes the U.S. Treasury market so safe? It's the fact that huge amounts of money can flow in and out of U.S. Treasuries without having much of a ripple effect on yields. The same thing cannot happen in the Eurozone because the Eurozone bond market is fragmented. They're all small markets. They can go into one, but not all together. If they have one common market, Eurozone bonds will flow into, buyers can flow into the whole Eurozone market of 13 trillion, so it will become like the U.S. It will become as attractive, as liquid as the U.S., and there's a premium. Investors are willing to accept lower yield in order to have the benefits of this liquidity. This is the magic of the Eurobond and how it could benefit the Eurozone countries.
Excellent. Speaking of flight to safety that you mentioned, we have another question here, Kumaril, who's asking how gold will play in all of this. So as money is presently flocking out of some European zone countries towards safety, is gold going to be a haven?
That's always a good question. The initial impact on gold will be downward, because in the event of a collapse or major crisis in the Eurozone, the fear is that it will slow global economic growth, therefore tip the balance from inflation to deflation, and that will take steam out of the gold market. So the initial response will be a drop in the price of gold. However, gold is has intrinsic value. All the paper currencies in the world, including the US dollar, are just paper, backed by the confidence and trust of the public. Which means if in the next phase, if countries try to reflate in order to deal with the crisis, that will set off inflationary expectations, undermine confidence in paper currencies, and that could cause the biggest run-up in the price of gold. But that will happen later, not sooner. The investors
Okay.
must expect a drop in the price of gold, which will create a historic buying opportunity. And then when countries rush to save the day, that's when gold price will rise again.
Excellent. Okay, we have another question, this time from Vanny. In many European countries, people living in rich areas sometimes are quite resentful towards people living in poorer areas because the latter are perceived as living off the wealth produced by others. How do you suggest politicians address the issue of richer Eurozone countries paying the debts of the poor countries, as your approach would suggest?
That's actually an excellent question. You see, this is the perception that prevails in Northern Europe, in core European countries. But it is entirely wrong for the following reason. The Euro core has benefited by selling goods to the Euro periphery. They're the ones building the bridges, being the airport facilities, selling Mercedes cars to the periphery. And in any economy, including in Canada, we have areas which produce more, others which produce less. The issue doesn't arise because we have a common Canadian government bonds. Whereas in Europe, these countries have benefited a lot from what is going on in the South. And the South is not asking that the North pay for their debts. What the South is asking is to combine their debts, form a common bond, European bond, and then they will all be able to borrow at lower rates, and they will all be able to prosper together.
Excellent. So the fact that the Eurozone countries benefit collectively from the Union is the reason why countries such as Germany don't say, well, we're the ones departing from the zone. It ends up being beneficial to Germany and other countries that are doing well.
Exactly. You see, if Greece started becoming as competitive as Germany is, then Germany would not have an export surplus with Greece or Italy or Spain. Then it would become harder for the German workers and German manufacturers to sell their goods within the Eurozone. So if they want them to cut spending and restructure the economies, they have to expect that production will fall, exports will fall, and that will hurt all of them. And if incomes fall, the debt to GDP ratio will not be resolved. It will continue to rise. So their strategy is meant to fail.
I see. Just this past Sunday, New York Times Nobel laureate Paul Krugman predicted that Greece could be abandoning the euro as early as next month. Others as well have mentioned, you mentioned this in your presentation, that the risk of Greece's departure from the currency is currently higher than 50%. Mr. Krugman then went on to predict that this could mark the beginning of the end for the euro. So what would a post-euro world look like, in your opinion?
Well, it depends on whether few or more countries exit. If it's just Greece and Portugal, the collateral damage will not be as severe, although it will be bad. If Spain or Italy do, well, it's effectively the end of the euro experiment. And what will follow is that if countries return to their old currencies, there's going to be a sharp depreciation, devaluation of their currencies. That will throw the whole eurozone economy and the global economy into enormous amount of instability, because there's a lot of question marks that cannot be answered. We don't know how it will affect the politics, the psychology of investors, of the citizens. So it's going to be a huge mess, a mess of global proportions. And, you know, basically like what happened in the 30s, in the 1930s, following when England abandoned the gold standard, and through the the European and world economy into the depression.
We have another question from John. He is asking regarding the establishment of a common Eurobond. If the Euro leadership went this route, would an approval vote or referendum be required by the citizens of those countries, or can the countries simply ratify this type of structure?
First of all, the leaders, the 17 leaders would have to agree to it, and then they would have to put it either to their parliaments for a vote or to national referenda. So they have the choice of either have the parliaments approve it or have their population. So it could go either way. But it will need approval. But if the Eurozone were to signal their intention to go that route, that would restore a lot of the lost confidence. That would buy enormous amount of time for the countries to resolve their problems in the meantime. What the global bond markets are looking at is not just a current problem. They don't see a solution. They don't see a vision to resolve the problem. They don't see a sustainable solution. They don't see the willingness of the Eurozone governments to move in that direction, and that's what scares them most.
If resistance to a common Eurobond is limited to only a small number of countries, is it not possible for the remaining countries to come together and establish a bond that would be collective but to a subgroup within the Union?
Absolutely, yes. That is an option. However, you know, before we go there, it will have to be considered at the collective level of the 17 present members. If we start seeing breakups, I actually can see that the remaining members might ultimately move in that direction. The lesson from the Greek experiment might induce them into common sense and say, well, if we're going to keep this, that's what we have to do, because frankly, that's the only solution. A common European treasury with common budget rules and Eurobond, a common Eurobond.
Excellent. Thank you very, very much. This concludes today's presentation. On behalf of McGill University School of Continuing Studies, I'd like to extend a special thank you to our speaker today, Dr. Ken Metsiorinis. When leaving this presentation, we invite you to fill out the feedback survey, which appears in a pop-up window. Your comments and feedback will be greatly appreciated. We invite you to visit the McGill School of Continuing Studies website and check upcoming webinars and workshops. Thank you very much and have a great day.
Thank you.